Hey guys, it's Nick, and in this video I want to talk about the Clubhouse interview last night between Elon Musk and Robinhood CEO Vlad Tenev. It was pretty interesting what he said about the whole situation between Gamestop and restricting trading and all of that, and his explanation of it. It's a little complicated, and so I'm going to try to simplify it using a graphical form so you can see it pretty simply how it works. Now, I'm not claiming to know what happened. You could watch this video and make up your own mind on what you think happened. Did he get pressure from hedge funds to restrict trading in these stocks? Or did the clearinghouse up his margin requirements so much that he had to restrict the trading? Or did they get a call from very powerful people to increase his margin to force him to stop the trading in these certain stocks? It's kind of like three possibilities, or maybe none of them. So let's see how that looks. In the interview, Vlad said that the NSCC asked for the additional margin. Now, the NSCC is just a subsidiary of DTCC, the clearinghouse. So they're one and the same, really. Let's take a quick look at the mechanics of buying and selling. Let's say this buying broker is Robinhood, this selling broker is Schwab. So Robinhood has a buyer that wants to buy 1,000 shares of GameStop. Schwab has a seller who wants to sell 1,000 shares of GameStop. They meet in the marketplace at the agreed upon price. That information goes to NSCC, who then takes the money from Robinhood and gives it to Schwab to pay the person who sold. And then the other information goes to DTC to change the title on those shares of stock. Now they net out the shares at the end of the day. So if Robinhood customers bought 1 million shares of GameStop and other Robinhood customers sold 900,000 shares of GameStop, then they would only have to worry about 100,000 shares of GameStop additional margin risk. So let's see how this whole thing works according to Vlad during the interview in Clubhouse. So this is Robinhood, this is the DTCC clearinghouse, and Robinhood was chugging along. These are the stocks of their customers, buying and selling stocks, and their risk was about the same most of the time. And so the margin that DTCC asked for every day at the end of the close was roughly the same. So it might go up by a little bit, it might go down by a little bit, depending on the risk that they assessed of the holders of all their stocks. Now, Vlad said that the usual daily margin they had to deposit with the DTCC was $300 million. So every day the DTCC would send them a bill of how much they need to deposit in total. And so if their account with the DTC was less than they needed to deposit, they would need to add some more funds. So their normal bill is 300 million, so they deposit 300 million with the DTCC or the NSCC. And so they're good as long as their risk stays the same. The way Vlad tells it in the interview is that they started getting a lot of new customers, and so the new customers and the existing customers were all buying GameStop and these short squeeze kind of companies. So instead of just a little bit of risk with the GameStop and these short squeeze, they started getting more and more and more of this risk. And so the NSCC supposedly saw this risk and, based on their models, sent them a new bill. And that new bill went from $300 million in margin to $3 billion in margin, or one order of magnitude higher, 10 times higher, as Vlad says in the interview. Now, Robinhood has only raised $2 billion from investors since it started, so it did not have $3 billion to pay for this margin. Now, how did the NSCC go from on Wednesday only needing 300 million in margin to on Thursday needing 10 times more, or $3 billion in margin? How do they calculate this risk? So according to Vlad, he said it is calculated using VAR, value at risk, and another discretionary term, which he doesn't know how they calculate that discretionary term. Now, value at risk is a valuation measure that banks and hedge funds and investment companies use to see their risk over the whole company, their whole investment portfolio. And so they use it to run simulations to see what would happen if the market went up 5% or did this or did that, to see if their portfolios would withstand the risk within the parameters that they want. And so a value at risk model might say that, okay, your portfolio has a 10% risk of dropping 20% within the next 30 days. And so depending on what time periods and what markets they look at, you can kind of come up with any VAR that you want to if you chose to do it. So did they change their VAR models purposely to increase the margin required, knowing that it will shut down the trading in Robinhood? Or did they do it because they really did see the increase in risk and are worried about the risk to the system and to their solvency if they don't increase the margin risk? I don't know this at this point. We may find out in the future. So what Vlad said was that after some back and forth with the NSCC, they agreed to lower the margin required from 3 billion to 1.4 billion. But that still was not enough because Robinhood did not have that kind of money. And so what Vlad said was, after some negotiation with the NSCC, they came up with a plan that if they restrict the trading in those short squeeze stocks that was causing the increase in the margin, they could lower the margin required to only 700 million instead of 3 billion. And so they would have to put up an additional $400 million, but that would require no more buys in Gamestop and these other short squeeze companies, and only people could sell their position out. They can't initiate new long positions. So that's what happened, and that's why they restricted the trading in these stocks, according to Vlad. So since that happened, they went and drew down lines of credit from banks that they had for like $600 million. They also got a $1 billion investment from 2 investment companies, and just over the weekend, they got another $2.4 billion investment from other companies. So in the last few days, they've gotten $4 billion to shore up the company for these increased margin risks. And so I guess that's in the hope that they can deposit some of that money and let people trade these short squeeze stocks again to some extent. I'm not sure how much, but that's the plan now at least. And so on Friday, they had a list of 50 stocks that you could only trade 1 share or up to 5 shares. That list has been pared down now to only 8 stocks that are restricted like that. So a simplified way of thinking about this is thinking about cars and car insurance. So pretend Robinhood was a household and Charles Schwab was a household. And even though Robinhood average account is about $1,500 and the Charles Schwab average account is $300,000, so you would think that there's more risk in Charles Schwab account holders, but if they're not all concentrated on one stock, the risk kind of cancels out a lot of times. So if half of the people are long IBM and half of the people are short IBM, the net risk is, say, 0. But if in Robinhood everybody is long the same stock, the risk is increased. But so let's say these 2 households, right? You have the parents own boring Camrys and they drive 50 miles an hour, and if something happens to the car, the worst that can happen is they lose 20 grand, the cost of the car. The insurance has to only pay out 20 grand if it's totaled, but it's not likely to be totaled because they drive like old people, right? And they have some kids that also drive pretty normally, except for their youngest kid that happens to have one Bugatti Veyron or Chiron, whatever it is, that goes 200 miles an hour, and the kid has a couple speeding tickets. So he's a big risk. But out of the 6 cars, there's only one of these guys. So the risk is less for Charles Schwab for their monthly car insurance bill that they have to pay to the insurer. Now, Robinhood, maybe it's more like 50% risky and 50% boring Camrys, right? That was a week ago. But as Vlad said, in the last few days, all these people are opening up new accounts, and their existing account holders are all buying the same stock, Gamestop. So now it's like you're getting a whole bunch of more teenagers with Bugattis with speeding tickets on their record. So the chance of them crashing and causing a lot more damage has increased a lot for Robinhood, where it hasn't increased that much for Schwab. So that's why they need to have a much higher margin maintenance balance at the NSCC than maybe Charles Schwab does for equal amount of customer money. So guys, I hope this video made it a lot simpler and easier to understand what Vlad Tenev was talking about in this Clubhouse interview. I don't know what the whole truth of the situation was, but I tend to think that what he said sounded mostly truthful and mostly plausible. So make your own mind up about if he really restricted people from pressure or just from the NSCC, or was there pressure on the NSC to pressure Robinhood? I don't know. Maybe we'll find out in the future. Who knows? If you like this video, give me a thumbs up, and I'll see you on the next one, guys. Thanks for watching.